In the middle of June, the market cap of SpaceX peaked at almost $3 trillion, but since then, it's taken a bit of a nosedive, and for good reason. Because not only has it lost over 50% of its market value in less than 2 months, a lot of experts are suggesting there's plenty more pain to come for SpaceX investors who bought at the top, share unlocks that could further tank the share price, a massive gaping hole in their finances, and a CEO juggling more projects than he can handle. Here's why SpaceX is in a world of trouble. To understand how SpaceX fell so far, so fast, you first need to understand why it became so valuable, albeit only for a matter of days, in the first place. Because what happened in the build-up to the SpaceX IPO in June is something we'll probably never see again in our lifetimes. SpaceX had been a private company for over 2 decades, having been founded in 2002 after Musk sold his stake in PayPal. For most of that time, the only way to invest in it was through some kind of private equity or venture capital firm. Ordinary retail investors were locked out entirely for years, watching many impressive feats achieved by the team. And by the time the IPO was announced, the demand for trying to get a piece of the pie was unprecedented. SpaceX ended up raising over $85 billion in what was by far the largest initial public offering in the history of the stock market, pricing shares at $135 and valuing the company at around $1.8 trillion. Investment platforms reportedly received about twice as many orders as there were available shares, with total demand hitting around $250 billion, significantly more than the $85.7 billion being raised. The first day of trading in mid-June set the tone for everything that followed. The stock opened at $150 and finished day one nearly 20% above its $135 IPO price, closing at $161, putting its first day market cap above $2.1 trillion, making it instantly one of the most valuable companies in the world, even larger than Tesla. Trading volume exceeded 500 million shares, another first day record, and the momentum continued through the following week. On the 16th of June, just 4 days after listing, the stock hit its all-time high of $225.64. At that point, SpaceX's market cap peaked at just shy of $3 trillion, putting it for a while amongst the 6 biggest companies in the world. The hype around SpaceX during this time wasn't entirely fake. SpaceX was genuinely one of the most exciting companies on the planet, pushing the boundaries of space travel and engineering to achieve things never done before. SpaceX is the dominant force in commercial spaceflight, operating roughly 83% of all US spacecraft launches. Starlink, its satellite internet business, has over 10 million subscribers across 164 countries and is continuing to grow. But after the hype peaked in the middle of June at $225.64, it stopped almost immediately. Within weeks, the stock had shed most of its gains, and by late July, it fell below the IPO price of $135 for the first time. By August 1st, it closed at less than $110, down more than 50% from its all-time high. SpaceX has now erased more than $1.2 trillion in market cap since its peak, almost exactly the current total market cap of Tesla. And Musk's time as the world's first trillionaire was short-lived. But here's the thing. None of this should surprise anyone who took the time to look into the underlying numbers before making the decision to invest. SpaceX posted a net loss of $4.9 billion in 2025 and a further $4.28 billion loss in just the first quarter of 2026 alone, with revenue at around $4.69 billion. The company's accumulated deficit sits at $41.3 billion, a number most of the IPO investors probably weren't aware of, and the operating losses are just as bad too. SpaceX posted a $2.6 billion operating loss in 2025 and a $1.9 billion operating loss in Q1 of 2026 alone. The XAI merger, which was finalized in February 2026, when Musk folded his artificial intelligence company directly into SpaceX, is the most significant driver of the company's current financial struggles. Quarterly expenditure on AI infrastructure alone reached $7.72 billion in Q1 of 2026, accounting for 76% of the group's total spending. And SpaceX's bond market are also backing up the fact that SpaceX is in trouble. The company's 6.65% notes due in 2056 have fallen from 97 cents to 87.6 cents on the dollar since the IPO. SpaceX's trailing 12-month earnings per share minus $2.94. There are literally no earnings. There is no price to earnings ratio to calculate, because there are no earnings to divide the price by. What there is instead is a price to sales ratio, and at peak valuation, SpaceX was trading at approximately 94 times its 2025 revenue. Even after the 50% decline, it still trades at roughly 49 times expected 2026 revenue, which suggests that despite halving in value in recent weeks, many experts will say that SpaceX is still very much overvalued. For comparison, Nvidia, currently one of the most profitable and fastest growing companies in the world, trades at around 22 times revenue. Apple trades at around 9 times revenue. It is still, by almost every traditional financial metric, massively overvalued, because even at a $1.4 trillion valuation, the revenue falls far short of companies valued at this range. Meta, $56 billion in revenue. Tesla, $22 billion. Samsung, $90 billion. Warren Buffett's Berkshire Hathaway, $93 billion in revenue. And if we go back to where it was at its peak, you can see just how crazy a $3 trillion valuation was. Nvidia quarterly revenue, $81 billion. Apple, $143 billion. Google, $110 billion. Microsoft, $78 billion. Amazon, $180 billion. So SpaceX, with a measly $4.7 billion, is not only in a different league, it's on a different planet, no pun intended. Morningstar published its analysis before the IPO, and here's what they said. We value SpaceX at $63 per share, a 53% discount to the IPO price. Our valuation is the result of mathematics more than skepticism. Even in our most optimistic moonshot scenario, the company would be worth $154 a share, and we assign that scenario a 7% probability. So to a lot of people, even holding SpaceX stock at $100 a share seems risky. But there's more bad news for SpaceX holders, with more upcoming events that could plunge the share price down even further. More than 900 million new shares, worth approximately $116 billion, will be unlocked for trading for the first time in the coming days. That's nearly 1 billion shares held by insiders, employees and early investors who've been waiting years for a public market to give them an exit so they can finally cash in on all their hard work. The combination of nearly 1 billion unlocking shares and a 32% short interest creates a situation that could prove costly for those who succumbed to FOMO during the craze of the IPO. All of this on top of a company that is currently trading at nearly 50 times revenue. Yeah, tough times ahead for SpaceX investors. The people who bought at $225 are already sitting on a 50% loss. The people who bought at $135 on IPO day are now slightly underwater, but it could get a lot worse. All for a company burning through billions of dollars every quarter, at a valuation that still prices in decades of flawless execution on technology that hasn't been properly demonstrated yet. The risk to reward is so off for this company, it's hard to believe why anybody wanted to invest at these valuations in the first place. SpaceX's fall is dramatic enough on its own, but it's also happening in the context of something much bigger currently unfolding in the stock market, a near global reassessment of whether the AI and tech industries as a whole has been valued correctly, and the early signs suggest the answer is a resounding no. The problem isn't technology. It's not whether AI or tech has valuable use cases, but whether the astronomical sums being spent on AI infrastructure will ever generate returns that justify the valuations being applied to the companies building it. The problem is simply the financials, and the questions surrounding SpaceX are getting ever more frequent. But look at the two most valuable private AI companies in the world, OpenAI and Anthropic. OpenAI is preparing to ask public investors to value it at more than $1 trillion, despite $25 billion in annualized revenue, and projects losses of tens of billions of dollars in 2026, with no path to profitability before 2030, a $1 trillion valuation on a company that will have lost over $100 billion before it turns its first profit. These numbers are making investors hesitant of the vast majority of companies in this sphere that aren't yet consistently profitable, and SpaceX, along with some of these AI companies, are near the top of the pile. The pattern across the entire tech sector is the same, SpaceX included. Insanely high valuations, combined with enormous losses and debts, with FOMO spreading like wildfire, or at least it was before the IPO, despite many people making connections to the dot-com bubble in terms of how overvalued some of these companies currently are. It's not a new phenomenon to be investing in companies based on future projections. Amazon lost money for years before becoming one of the most profitable businesses in history. making early investors very wealthy. But Amazon was also not valued at 50 times revenue while doing so, and isn't still one of the top 15 or 20 most valuable companies in the world. The multiples being applied to AI companies today price in near perfect, decade-long flawless execution in the most competitive technological arms race in history. The valuations are just unthinkable, and if you're thinking SpaceX might be the next Amazon or the next Nvidia, simple maths will tell you that you're way off, and in truth, the next Amazon is going to be a company we wouldn't have heard of for years to come. The conversation around SpaceX and the wider tech industry has shifted from the fear of missing out to the fear of holding the bag for years to come, and not only does the share price reflect that, but every major investment indicator suggests that SpaceX should never have been this high in the first place. As of today, SpaceX simply does not have the revenue, the infrastructure, or the growth potential to be a trillion-dollar company, or, to be honest, anywhere close. It's still a cool firm, tackling real problems and creating real value, but the scale and speed at which this company grew is just insane, and it's going to leave a lot of emotional investors holding the bag, not to mention all the pension funds that will be piling their money into it too. We're comparing this company to giants of the tech industry that have been some of the biggest companies in the world for decades: Apple, Amazon, Microsoft, and here we are talking about a company that made $4 billion in revenue in the first quarter of the year. Well, like I said earlier, Apple made $140 billion, Microsoft made over $70 billion, Amazon made $180 billion. And to be completely honest, if you were excited about buying into SpaceX at trillion-dollar valuations with these figures, you only have yourself to blame for any financial losses you're inevitably going to incur. The hype around SpaceX was arguably the most extraordinary in stock market history. The basic principles of investing were thrown out of the window, but they were always going to find a way to climb back through. And that's where we are right now. Don't fall for the hype. Stick to the fundamentals, and when there's a company that everyone wants to throw their money at, chances are you're already too late. Thanks for watching, and be sure to subscribe for more videos like this one.